Welcome to another Be Wealthy 2 production. I want to talk to you about what you must know about money and stocks. There's a lot of people in our workshops and seminars and one-on-ones that have a lot to ask concerning money and stocks. And so I'm going to give you a basic introduction to money and stocks, and I believe you'll tremendously benefit from it, and then you'll be able to go further in some of the things you might want to do. First thing I want to talk about is there's 6 levels to wisdom. And I think there's something that's very, very essential and important because I'm really talking about financial literacy because until you get your financial literacy up, you won't know how to respond when certain situations and circumstances hit your life that are going to hit all of us. So how to walk in financial freedom, we've got to first have wisdom. And it's going to take time to implement what it takes in order for us to have that wisdom. Number one, we have to have excellence in paying attention and listening. That means I got to get distractions out of my life. There's always something trying to get your time. Always something trying to get your time. But I believe if you're watching this video, it's because there's something in you that's saying, I want to do more. I want to do more with my life. And so you got to have excellence in paying attention. You got to be aware. Number 2, excellence in asking questions. If you're really paying attention, you're listening, your questions should relate to the material that you've heard. Sometimes people ask questions that have absolutely nothing to do with anything they're reading, anything they're being taught. And so excellence in asking questions is to get from the people who have the material at a level beyond where you currently may be, the answers that are going to help you come up to that same level. 3, an excellence in understanding. Understanding means to take the same position. So in order for you to take the same position, you really have to have heard the position. And so I think this is critical, important that you have an excellence in understanding, that I'm able to understand, take the same position in this situation and circumstance as those who have a form of knowledge that helps them be able to respond. Number 4, excellence in memorizing. You know, I had a geometry teacher that said the memorization of facts is not knowledge. But there's one thing that's very important about memorizing. If you're going to learn how to practice things in the area of finance, it becomes a habit. I got to memorize certain things. I got to get them in the area of practice until it becomes the natural thing for me to do. Number 5, excellence in sharing what you learn. I think it's so very essential and important. When you learn something, it's important that you share it with somebody else. Sometimes even sharing it with others is how it gets solidified in you. And 6, the fruit of knowledge is implementation. And that's wisdom. My definition for wisdom is what to do next, knowing what to do next. When you have wisdom, you know what to do next. So to walk in financial freedom, you must acquire quality information that, if used correctly, will lead to your financial success. That's what Be Wealthy 2 is all about. We want you to be financially successful. We want you to have harmony in your relationships. We want you to get out of that debt, learn how to get credit worthiness flowing in your life so that you can have generational wealth and so that you can be a blessing in your generation, your family, and generations to come. Now, Harriet Tubman said something that I think is so essential. She said, I freed 1,000 slaves. I could have freed 1,000 more if they only knew they were slaves. I've talked to a lot of people about money and stocks. And sometimes you're talking to people who, when they respond, you can tell that they don't think they're a slave to their money. They don't think that it's got to be in bondage. They don't think they're a slave in any regard. But Harriet Tubman, who freed many slaves through the Underground Railroad, she said, I could have freed 1,000 more. But they didn't think they were slaves. They thought they were free. I want you to be in the know. Refuse to be a slave. Subscribe right now to Be Wealthy 2. Subscribe, get all this information. There's other great people out there sharing great information that you need to get. Do not be a slave thinking you're not a slave. So let's talk about money. What is money? And I think it's very important. I'm speaking from the perspective of someone living in the United States. So after August the 15th of 1971, our president on that date went on the national television and made an announcement that he was taking the United States off the gold standard. After that action happened, money just simply became an idea. It's a perception. It's an agreement we all make with each other. That's what it is. It has value because we say so. It's backed by nothing. In the United States, since our money is no longer backed by gold, money is really currency. Currency. It's currency because it flows to the organized and away from the waster or the one who is not determined a plan for it. So when you have businesses or you have finances or whatever in your life of resources with no plan for them, they end up leaving your life and ending in the life of someone who is organized. So since it's currency and will lose value, it must be invested in assets that will bring more. Money is currency. It's got to move or else it's going to lose its value. So I got to know something about assets. It's important. Now, currency must be moved to increase in value. If it sits in your pocket, your regular savings account, your box under the bed, it is losing value as you listen to this presentation. So let's talk about some money facts. Assets put money in your pocket. And that's the bottom line. Anything that's putting money in your pocket can be considered an asset. So an investment in stocks, real estate, bonds, etc., is how you purchase assets. Liabilities simply take money out your pocket, period. Your student loan, your mortgage, your car loan, your store loan, your credit card, they're all liabilities. They all take money out your pocket. Every one of them has a payment that you have to pay that's an expense every month. You don't purchase assets with money, though. You purchase them with time. If you don't value time, you typically will waste money. If a car payment is $400 and you make $15 an hour, your real cost for the car is 26.6 hours. That's $400 divided by the $15 an hour you make. If you work a 40-hour week, the car costs almost 75% of a week's income. When you consider what things cost using the time measurement, it'll usually help you make wiser choices. How much time does that cost? That's something we have to think about, because if I value time, I value what it took time to get. More about money. Money is to be a tool to help you reach your goals. And that's it. It's a tool. It's an instrument. It's supposed to help me. Nothing helps me, though, unless I assign it to something. So money must be assigned to a goal, an idea, or task to work properly. If I've got money coming in under no assignment, it's going to leave my life. Money masters the person who does not plan its use. Harriet Tubman, she said, I would have freed 1,000 more, but they didn't know they were slaves. What about in this generation? We don't know that we're slaves to our money. And so the money masters you. Money tells you what to buy. It tells you what to do. It tells you what to go. It tells you what you can have. Instead of you saying, this is what I want to have. This is what I'm going to have. This is what I'm planning to have. And saying this money coming in is going to help me have what I said I'm going to have. It's very important. So let's talk about stocks for a moment. What is stock? Simply put, it's a share. A share of stock is an investment vehicle in a corporation that provides you with ownership rights and usually voting privileges. It is provided to you in the form of a certificate. I won't get into that in this presentation, but we'll be doing a whole lot more about stock, one of my favorite things, and we'll talk a little bit more about that then. So how do stocks make money? Now, stocks make money in two ways. One, capital appreciation. As the stock's market value increases, you gain profit. So if I buy the stock for $100 and it goes up to $115, I just made $15. That's capital appreciation. Number two, dividends. Some companies pay dividends. That's part of the company's after-tax earnings distributed to stockholders. So if you own McDonald's stock, at the time of this recording, McDonald's just released a dividend payment in June of 2020. They paid dividends for every share you owned. You received a certain amount of money per share after they had already taxed and concluded what their earnings were after taxes. So those are the two ways that stocks make money. The price goes up, or the company gives you a dividend after their taxes have been determined. Now, how do companies get on the stock market? They call it going public. Number one, the company will issue an initial public offering of shares. The company uses a lead underwriter or a brokerage firm that takes the company to public markets via a stock offering. Now, this is very important because a lot of times when you hear the news or it's in the paper that this particular company is going public, that announcement is not for everybody. Even though it's being heard by everybody, that announcement is general public announcement, but that's not the only announcement that went out. There was a private announcement that went out because, number three, there are primary and secondary markets for stock. Now, for the original buyers are the primary market. Now, that's the people who got the announcement first. That's before it went in the newspaper and it became available to everybody. The brokerage firms, more valuable clients, the ones who spend the money, the ones who do the deals, were informed, and they're the original buyers, and they're called the primary market. Number five, the later buyers are the secondary market. Now, when the initial offer goes out, as I said before, the primary, it is usually reserved for the brokerage firm's best clients. Seven, the people who buy shares in the primary market then have the right to turn around and start selling those shares to the general public in the open market. Now, this is a secondary market, or what's called aftermarket. That's where the price fluctuates. So the primary market gets to buy the stock at a set fixed rate. When Facebook first came out to the primary market, it was a set fixed rate for those people to get in. But when it goes to the secondary market, the price now goes up $22, $40, $35, $15. It fluctuates. Number eight, most of us get to purchase securities or stocks in the secondary market. Now, there's three main types of stocks, and this is very important if you're going to invest in stock. The first type of stock is called an income stock. Now, these are companies that generally do not reinvest a big part of their profits back into the company each year. They pay a dividend to shareholders, usually 4 times a year. McDonald's is an example of this type of stock. I just told you that at the time of this recording, June of 2020, McDonald's just released a dividend. So they're an income stock. So in other words, I don't purchase McDonald's stock because I'm expecting the price to go from $200 to $600. I buy McDonald's stock because I intend to buy a lot of shares and I'm going to look for that dividend every quarter. So because I got a lot of shares and they pay a dividend every quarter, I'll get a good amount of income from owning that McDonald's stock. This is the reason why McDonald's pays a good dividend every quarter, because they realize their stock is not going to increase by large numbers over a 2 or 3 year period. Now, second type of stock is growth stocks. These are companies whose primary objective is to grow. The dividend income from them is usually small or non-existent. Now, Amazon is an example of this. They don't pay a dividend. So if I buy Amazon stock, I buy it because I believe that the market value is going to go up. I'm not expecting a dividend. I'm just looking to see it go from $1,000 to $1,100 to $1,200 to $1,400 to $1,500. I'm expecting to see the stock price go up. So it's a growth stock, and that's why you get in. Berkshire Hathaway, which is the company owned by Warren Buffett. You know, if you wanted his A shares, you're spending $230,000 a share, because it's a growth stock. That stock was in 1997. You could have got that stock for $30,000 a share. Now it'd be $300,000 a share. So the stock grew. And so you're looking to get in because you expect the value of this company is going to go up. Third type of stock is value stocks. These are stocks that have gone down in price but remain a good buy. You buy because you believe you're getting a good price and that eventually the market is going to realize the price and it's going to increase and you're going to win. Now, I personally believe that PG&E is an example of this type of stock. It's a utility company in California. PG&E is in bankruptcy, but they're coming out of bankruptcy. Plan has been approved as of June the 8th, I believe it was. But the reality is that I know people need utilities, and I know the state is somehow going to protect them. And so it's a good buy, $10, $11, but the company had been up to $40, $50 at one time. So those are companies that could be undervalued for one reason or another, but the value will increase. And that's one company that I believe that could happen for. Now, there are three different things, or four or five, it depends on where you are. You'll hear about companies, and it's called cap. Everything with a cap in it refers to the company's market capitalization. Now, that's a big old term, market capitalization, but it means the total amount of capital the company has at its disposal from all the shares investors have bought. Now, the reason why I'm going into this is because you need to know the difference between market capitalization, or market value, and book value. We're going to talk about that in just a moment. But here, it's everything they have at their disposal from all the shares investors have bought. This in turn signifies its size. So when you look to buy companies, the smaller the cap, the more risk typically associated with the company, the more likely the company could have financial issues, could go out and stuff like that. So there's a greater risk for the smaller the cap. So you figure market capitalization out by multiplying the number of shares outstanding by the price per share. And in this particular presentation, I'm not going to get into that too heavy. The first type is a small cap, and it's not typically really the first type, but it's the first one I'm going to get into. Some small cap. It's a company with market values or market capitalization, and those are interchangeable, market value, market capitalization, under $2 billion. Now, 80% of the top 80% of the top 500 publicly held companies, as well as companies not ranked in the top 5,000, 80% of those companies are small cap. Mid cap is the next one. This is a company with market values of $2 billion to $10 billion, and about 15% of the top 5,000 companies fit in that category. The third category today is large cap. Generally, large cap companies have a market value of over $10 billion. They are typically well established with solid histories of growth and dividend payments. Now, typically that's the last one you hear about, but there is mega cap, and it refers to companies with a market cap of greater than 200 billion. And you'll hear Apple in these names, and Google and Amazon. You'll hear these types of companies that are mega caps. Their capitalization is over 200 billion. Now, we're going to talk about actual value versus perceived value, because you need to know when you're going to get into stocks and you're going to start looking at how do I decide what the real value of a company is and how much I should pay for it. There's some things that you just want to know. And I'm so glad you get the opportunity to play this over and over again and to take notes, get it down, but you want to learn this. When we talk about market capitalization, we're talking about perceived value. So when you look at the price of a share of stock, they say that McDonald's is trading for $212. That's not the book value. That's not the real value of that company. That's the perceived value. Remember I told you money is an idea? People agree that a company is worth so much, and we get a price that goes up and down on the perceptions of people. Recently, there was an announcement made that they may have to close back down again because of coronavirus. That particular day, the stock market went down 1,800 points in one day. That's because that's perceived value. That's people believing something's going to happen. In their perception, something's going to happen. So selling started happening. People started dumping stock. And as they dumped it, the prices began to drop. So actual value, though, is book value. Now, book value, which is actual value, is the total value of a business's assets found on its balance sheet and represents the value of all assets if liquidated. So if they sold everything they had, that's their book value. Everything they had and paid off their debts. Everything they had and paid off their debts. That would be their true book value. Now, market value, which is perceived value, is the worth of a company based on the total value of its outstanding shares in the market or its market capitalization. Now, again, that has a lot to do with what people think is going to happen in the future. That has a lot to do with who's the CEO, how long they've been there, their success or failure record, but it's perception. And that market value tends to be greater than a company's book value, since market value captures non-tangibles, what we feel, not so much what they're selling, as well as future growth prospects. This is important. So the book value literally means the value of a business according to its books. That is reflected through its financial statements. Theoretically, book value represents the total amount a company is worth if all its assets are sold and all the liabilities are paid back. This is the amount that the company's creditors and investors can expect to receive if the company is liquidated. So book value equals your total assets minus your total liabilities. So for example, if company XYZ has total assets of 100 million, total liabilities of 80 million, the book value of the company is 20 million. In a broad sense, this means that if the company sold off its assets and paid down its liabilities, the equity value or net worth of the business would be $20 million. Now, market value. The market value represents the value of a company according to the stock market. While market value is a generic term that represents the price an asset would get in the marketplace, it represents the market capitalization in the context of companies. So it is an aggregate market value of a company represented by a dollar amount. So it simply represents the market value of a company. It's computed based on the current market price of its shares. Now, the formula, market value, also known as market cap, is simply calculated by multiplying a company's outstanding shares. So if you got 100,000 outstanding shares and your price is $10, then your market cap would be 1 million. It's your shares times your price. That's what the market value is. So if XYZ is trading at $25 per share and has 1 million shares outstanding, then the company's market value is 25 million. Market value is most often the number analysts, newspapers, and investors refer to when they mention the value of a company. But remember, that's a perceived value. The book value is the true value. Now, perceived value, market value, fluctuates. The more you understand what causes fluctuations, the more money you can make in stocks. I can guarantee you, when they thought it was going to be another COVID-19 shutdown and people were running and getting rid of stock, there are some very well-informed people who were not getting rid of their stock. They were buying more at that very same time. If you are ignorant of the fluctuations, the more money you can lose in the stock market. A lot of people are making big deal of the fact that Warren Buffett is not buying stocks in 2020. He's actually divesting himself from them in 2020. And so people watch, because if he's so famous and so successful in the stock game and he's not buying and he's actually getting rid of some of the companies that he has, maybe I should do the same. And people will move because he moved. But if you're ignorant of the fluctuations, the more money you can lose because you don't know why he's not buying. So the stock price is just like the US dollar. It has a perceived value. And if you know how to read the signs of the times, you can prosper in the markets. But ignorance is expensive. The more you know, the more you're going to prosper. Now, there's two main places to buy stock in the United States that mostly are known. Number one is the New York Stock Exchange, is the NYSE. Now, it's now known as the New York Stock Exchange Euronext. In 2007, the New York Stock Exchange merged with the Euronext in order to expand globally. Companies must be industry leaders to be on the New York Stock Exchange, and they pay an annual fee to be listed. Brokerage firms describe themselves as members of the New York Stock Exchange. This means they bought a seat on the exchange. This means one of their employees carries out orders to buy or sell on the floor of the exchange. In 2008, the New York Stock Exchange Euronext bought the American Stock Exchange. The ASE was known as Major Exchange for options as well as stocks. Now, this is important because the New York Stock Exchange is the exchange where you have to deal with a broker. You can't buy direct. You got to go through some brokerage firm, some agency, something to purchase. That's why the firms have a seat on the floor. Now, the second one is pronounced NASDAQ, and it stands for the National Association of Securities Dealers Automated Quotations. It is the youngest of the three markets. It launched in 1971. It is the nation's over-the-counter or electronic stock market, linking buyers and sellers via a computer network. Brokers and dealers make a market in individual stocks by maintaining an inventory in their own account. They buy and sell when they receive orders from investors. So you're dealing direct. When you go through the NASDAQ, it's a direct. There is nobody on the floor. As a matter of fact, you don't see a floor. When you're looking on television and you see someone ringing the bell or people clapping or jumping up and down, that's the New York Stock Exchange. That's because there's people on the floor selling orders, making deals, whatever they're doing. NASDAQ, someone has the shares, you put in an order to get the shares, and it's all done by computer. Now, 5 facts to consider when buying stocks. And I'm going to be doing a separate teaching on this. It's going to be more elongated than what I'm going to share with you today. But I do want you to know these 5 facts. Number 1, a great business should be easy to explain. So I hear this all the time. What should I invest in? What people really are asking me is, what am I investing in? And I don't want to just have you follow what I'm investing. So I'm willing to share what I'm investing. But I would prefer that you understand how to invest. And I'm going to tell you one of the first things you need to do if you want to learn how to invest, don't invest in things you can't explain. If you can't explain it, why would you put your money in it? Listen, you don't buy things with money, you buy them with time. So it took you time to get that. Why would you give it to some broker to invest it in something you know absolutely nothing about because you simply heard somebody say something? Someone who was trying to sell you something, told you something, and you went and spent your money. So a great business should be explained. If you can explain what the product is, what the business is about, what they do, it's qualifying for you to take step number 2. Fact 2, a great business has brand recognition. So if you want to know where to put your money, if I said fast food, I can guarantee you certain companies just come to your mind right away because those companies have brand recognition. They stand out to you. If you understood, like for instance, in the United States of America, if you are in fast food and you're famous for being in fast food, your logos are red and yellow because they remind people of ketchup and mustard. That's not an accident. Number 3, great businesses never go out of style and sell products that require little to no updating. I like McDonald's. I've invested in McDonald's for a long time. Listen, the Big Mac is the Big Mac. If you get a quarter pounder, it's a quarter pounder. Quarter pounder with cheese, you got onions, it's what it is. And it don't require a lot of updating. The Happy Meal is the Happy Meal. Ronald McDonald is Ronald McDonald. This has been going on for years and years and years, and it's going to stay that way. If they change, you can order on a kiosk, you're going to be ordering the same burger on that kiosk. Fact number 4, great businesses are usually companies where the consumer will have to purchase the product or service again and again. That's why you don't necessarily want to invest in Ford Motor Company. Right now, stock is terrible because people buy a car every 5 years. I want you to notice it was a 60-month loan. Now they're 72 months. So now people are buying it every 6 years. Some of you can get them now, 80 months, 7 years. So people don't have to keep coming back to the car lot. But people go to McDonald's and buy oatmeal every morning. People go and get a bacon, egg, and cheese at McDonald's every morning. Wendy's came up with new breakfast now. People go to Burger King and get breakfast every morning because they buy the service again and again and again. Great businesses. And I'm not just talking about those companies, but great again and again and again and again. These are great products. Number 5, great businesses have pricing power, meaning they can raise prices without fearing losing their customers. Listen, if that Big Mac costs you 5 cents more, 10 cents more, you're not going to say, hey man, I'm out of here. I'm going to get me a different sandwich. You don't even care. If you're a McDonald's person, you don't care. I like Starbucks coffee. I go get a grande white chocolate mocha several times a week from Starbucks with the whipped cream. And listen, that thing has gone up and up and up and up in price. I pay $5.08 for that grande white chocolate mocha now. And that I remember when I was paying $3.65 for a grande white chocolate mocha. The price going up has not made me say, forget it. I'm just going to go to Sheetz and get coffee for 99 cents. If you like Starbucks, Starbucks is not afraid of losing their customers because they raise the price 5 cents, 10 cents, 15 cents. And so I'll repeat it again. Fact number one, great business are easy to explain. It's simple company. You can explain it. Brand recognition is fact number two. They don't go out of style. Their products don't require a lot of updating. Number four, they got people coming back purchasing the product again and again and again. And then they got pricing power. They can control their price. Now, here's what they can do about this price. Inflation, which is really the value of the dollar dropping. When the value of the dollar drops, these companies can be ahead of it. They can be raising their prices so that they're getting more dollars, even though the value of the dollar is dropping. Now, what to do if you want to invest in stocks? I'll give you 5 simple steps. Open an online brokerage account. Because in the day in which we're living in now, you open an online brokerage account because you have options available to you online that you do not have if you go and deal with someone in an office. So you get an online brokerage account. Number 2, select the stocks you want to buy. 3, decide how many shares you want to buy. 4, choose your stock order type. There's market orders. There's all different types. And again, we'll get into that in other presentations. And 5, optimize your stock portfolio. And this is going to be important if you keep following Be Wealthy 2 when we talk about optimization, because your stock portfolio, there's people who say diversify. I kind of agree with Warren Buffett on that diversification is the tool of an uneducated person. The more you spend time and understanding, you buy on purpose. You're not trying to buy this stock and that stock to hedge against one another. So I don't recommend anyone buy mutual funds for that very fact alone. So it's very important that you learn to optimize your portfolio. Now, I want to give you some suggestions. This is my suggestions, and others have different suggestions, but these are mine. The best online companies to use for investing, number 1 is the one that I use, which is I use Charles Schwab online. And I'm going to tell you why I believe these companies are good. And there's other ones that are starting to do this too. But when you can invest in partial shares, in other words, if I want to buy McDonald's stock and it's $200 a share and I only have $100, and you have companies that'll let you put $100 down and you get 50% of a share, and you keep investing until you get the whole share. But you start getting credit when you put down at least $5 for the share. That's one of the benefits of going to a Charles Schwab or Robinhood, where they may not charge. Now, Charles Schwab doesn't charge you anything to make the trade. There's no fee to make a trade. There's no fee to sell it. And so that's a huge benefit for someone who's trying to get in. Now, one of the other things about Charles Schwab, it's not a typical brokerage firm, it's a bank. And the way in which the Charles Schwab company is run, to me, it is absolutely amazing business. They're positioned to put a lot of people out of business because of the way in which the Charles Schwab business is structured. So I'm just throwing that out there. That's my personal favorite, the one that I use. Now, this next one, number 2, has come on strong. There are a lot of younger people that use Robinhood. They got an app. It's a very, very solid company. I would certainly say it's a great company for investing online. Then there's Stash. Then there's Zacks Trade. And then if you want to get into a company, I used to use Betterment. Betterment Digital uses an algorithm to invest for you. And so it's one of the different styles. It's much different than a Charles Schwab type. They use an algorithm, and they give you a survey, and based upon the answers to that survey where you want to be, they put you in the products that fit your answers, and the algorithm of the system that's been created makes the picks for you as to where it would bring you the results that you want. But those 5 companies, I should say, check them out online. You're not going to be disappointed. You will be helped. Now, don't just go and throw your money around. Remember, you don't buy assets with money. You buy them with time. I suggest you put time. Watch this again if you have to. Get other people's videos. Learn. Read books. There's great information out there. And there's also a lot of people out there just trying to take your money. So be wise. Be a smart person. And I believe that you're going to prosper in the days and years to come. And here at Be Wealthy, we're here to help see that happens. I hope you've enjoyed this time that we've had together today. Please subscribe. subscribe to the Be Wealthy 2 channel, and you see our links. Follow us on our links in Facebook and Instagram. And I've got a private group that we meet with and share relevant things with that private group. In addition to that, I'm open and available for one-on-one to help people as my schedule permits me to take those people on. So I look forward to connecting with you. Look forward to seeing you be successful and be wealthy too. I want you to be blessed.